Well, good morning, ladies and gentlemen. Here we made it. Dornbush download number 50. Cue the drum roll and the wolf whistle. Thank you very much. Yeah, who would have thunk it?
Yeah,
we did it. So very exciting times. Anyway, exciting times. Share market at the moment. Profit reporting season, and a number of companies have been reporting this week. And of course, today's blockbuster was CBA. Only $9.1 billion. Any thoughts on the result?
Yeah, look, pretty solid actually, Andrew. I thought, yeah, you know, the 9.1 billion, the 4.4 for the second half of the year, which beat Bloomberg consensus at least. So I reckon the market will be pretty comfortable with that. You know, a common equity tier 1 ratio, which is you know, a very important capital adequacy level we look at, around about the 9.1 mark. So nice and solid from that front. Few headwinds, you know, there's a little bit of margin pressure. All the banks are feeling that, of course, in the very low interest rate environment and a lot of competition around the place. But yes, Andrew, no, I think a pretty good result all in all. But of course, you know, other big news was the capital raising that they threw into the mix.
So what's, for those, a number of our viewers, our clients that actually hold CBA, what's the implications for them?
Yeah, so basically CBA, a bit like most of the other banks at this stage, looking at raising some more capital, you know, to fall under those international standards. So they've got their hand out for $5 billion worth, you know, a large amount of money, but in the context of CBA with a $140 billion market cap,
not that much.
Drop in the ocean, give or take. But yes, all existing shareholders have the opportunity to buy one new share for every 23 CBA shares that they hold at a price of $71.50. So, you know, give or take again a $10 discount.
Could be a bit attractive. Yeah. Okay.
So, so that'll be coming out over the next week or so. These rights will be renounceable, so effectively tradable on the market. So
similar to NAB.
Very similar to the NAB offering. So we've done a few calculations as well. Looks like this capital raising won't be too dilutionary on the price either. So, so no, all in all, the CBA investors should be reasonably happy with today's announcement, I would have thought.
So that's a good result. Let's maybe talk about a result that wasn't so flash. Cochlear came out yesterday. Sorry, there's a lot of them going on at the moment. Cochlear came out yesterday, below expectations, a cut in dividend. And the share price off accordingly, rallied towards the close, but still down around 7 or 8%. You know, we've been talking about healthcare companies. Would you be buying Cochlear at these levels, do you think?
Yeah, it's a tough one, Andrew. Cochlear's got a bit of a history, hasn't it, of disappointing. And we did see that yesterday, albeit full year profit was up 33%, I think it was, to 140 odd million. Market just expecting that little bit more. Around about 156 million was the consensus forecast.
So it was a big miss.
It was a big miss, absolutely. So, look, I think Cochlear all in all is a good business. You know, they've got a huge market share across the world. Again, they've got a little bit of a track record of this, so I wouldn't be too disheartened. Maybe let the dust settle a little bit and maybe pick them back up as they start to build again.
Those product recalls in those types of businesses scare me. You know, like if I drive a Holden as an example and there's a problem with the brakes, I take it up to Toowoomba Holden, high mark, and, you know, get the brakes fixed. Whereas if I have a problem with an ear implant, it's another operation. Like, it's a very serious thing. So those types of businesses, I'm just not wary, but I guess I'm just mindful that when things go bad, they go bad in a big way. On banks, Bendigo as well. What do you think of the Bendigo result?
Yeah, average, Andrew, to say the least. Yeah, you know, the result of, I think it was about 460 million was pretty much on the money from the market. Dividend was on the lower side. You know, 33 cents per share. Market was expecting around about 35, so a little bit disappointing on the dividend front. Again, margin squeeze for Bendigo. I think the net interest margin was only about 1.8%, so we tend to see it a lot around that 2% mark. And yeah, you know, common equity tier 1 ratio around the 8.2%.
So probably a bit low.
A bit on the low side.
So in other words, what you're saying is there's a potential there for a capital raising. You know, that's certainly a big risk for them as well. So pretty good dividend, in fact above average dividend, but that share price, I think it came right off. And I think, you know, Brendan with his technical analysis was suggesting that it got really bad. It could get to about $10.50. I think Dan, with the stuff he looks at, was saying about $11.10. So there's certainly a bit more potential pain coming there in the short term. We had one other one.
CSL today, yeah. So again, I guess on that healthcare theme, and again, CSL's been one that we have liked for a while. Not a bad headline result from CSL. I think it was about the 1.4 billion, and that's US dollars as well, of course. Again, market was probably just expecting that little bit more. On the positive side, CSL looks like they're going to continue that on-market share buyback. $950 million they did sort of last calendar year, so similar sort of amount this year. So the company obviously backing itself and buying back its own shares.
And it has done that for a number of years.
It has, yeah, and you know, that's only benefited shareholders. You know, less shares on the market, CSL creating some demand internally, I guess. So the prices reflected that. Dividends saw a nice little jump too, up to 66 US cents also. So again, historically not great dividend pays, the healthcare guys. But no, CSL soldiering along. They did have a big drop after that announcement, though. They have clawed back. I just saw there a few minutes ago, almost to get back to square. But
it's interesting, if you'd bought CSL day one, 1990 odd, they're now up 14,000%.
Not a bad earn.
1,000%. And they actually had a share split back in 2007. The last time they got to $100, they had a 3-for-1 share split. And certainly my view, and I'm sure it's your view as well, is that they will do another share split, you know, because there's something psychological about $100. People don't like paying $100 for companies, but they happily pay $30, even though they've got 3 times more shares. So, all right, so basically a busy reporting season. There's still an absolute ton to get through yet. We'll have plenty of material for the next 2 weeks. Anything else you want to cover off, Michael?
No, nothing really, Andrew. No, but you're dead right. Busy couple of weeks ahead, but certainly, you know, the CBA results setting a bit of a standard for the banks, so things rolling along pretty well there. But yeah, no, head down, bum up into some figures over the next couple of weeks.
Absolutely. Thanks for sticking with us for 50. Hopefully, at least another 50 more. Thank you.
Thank you.